Hello everyone, welcome back to our channel SparkPlug. Today we will take a deep dive into Hexaware Technologies, a company that has been making big moves in the IT and digital transformation space. Very recently, it was in the news for the IPO that got listed earlier this week. And it has embarked, this company has embarked on a journey of AI to technologies, bringing AI to technology services. But here's the thing, while everything looks rosy on the scratch, as we go beyond the surface, we uncover deep insights and hidden truths about Hexaware that are sure to shock you. Just before we start, before we begin, hit the like button and subscribe so that you don't miss any of our future deep insights. Let's start with Hexaware, who they are and what they do. Coming on to the business introduction itself, Hexaware or Hexaware Technologies Limited or HTL is a global digital and technology services company with artificial intelligence at its core, or so it claims. The company leverages technology to deliver innovative solutions. Start with the business introduction of Hexaware Technologies. Hexaware Technologies Limited, or HTL, as the short form calls them, is a global digital and IT services company. It has artificial intelligence at its core. Also, the company leverages technology to deliver innovative solutions for its customers' digital transformation and ongoing operations. Both in their draft and the final red herring prospectus, HTN has highlighted how it embeds IT into its solutions and has created various platforms, Tensai and a couple of others, to drive innovation for its customers and to also improve its business processes. Just one last thing. We will actually talk more about the AI services that Hexaware has claimed so boldly, and there are a lot of insights around the same. Hexaware broadly has 4 different services that it offers. It offers design and build, secure and run, data and AI, and cloud services. Further, it operates in 6 different market segments. It has financial services, healthcare and insurance, manufacturing and consumers, high-tech and professional services, banking, travel and transportation. This is how they frame it, but we have a take of our own of how and what are the hidden insights around these operating segments, and just stick around to hear that again. If you look at the operations, it is, as it is claimed, a global delivery presence with 39 delivery centers with 32,000 plus employees as of September, I believe.
So, Pramod, could you please throw some light on the historical perspective of Hexaware? I think it was established in 1990.
Absolutely. I think, Vivek, that's a great question that you bring up. Hexaware has been a sort of a roller coaster ride ever since it started. I found this buried deep into their documents. A lot of this was not very evident. Also, this is something that has not come up in a lot of reports or videos that I've seen about Hexaware. It has gone through name changes, it has gone through industry pivots, it has gone through demergers, listings, delistings. It looks like they were doing a corporate structuring course of business school, and they have a use case for everything. So if you look at it, initially Hexaware was named as Aptech Technologies Limited, Aptech Information Systems Limited to be sure. They changed the name around 2001 to Aptech Limited. Initially, the company was incorporated in 1990 as Aptech Information Systems Limited. They changed their name to Aptech Limited 1996. Again, there was a demerger of Aptech Training Institute or Training Limited with the main company in 2001. Aptech Training Limited, ring a bell with any one of you guys?
I remember taking IT trainings, like field trainings in Aptech. And it was one of those initial setups which used to train on the basic technology for a entry-level professional.
Absolutely, exactly. So Hexaware was that company. The erstwhile Hexaware Technologies was then merged into what was the non-training part of Aptech and called Hexaware Technologies Limited in 2002. It got listed in 2002 again. The original founder, Atul Nisar, sold Aptech in, I think, 2005 and Hexaware in 2013. As the Hexaware stayed listed, there was an investment from Barings Private Equity Limited, Equity Asia, now it's called EQT. When Atul actually sold this, Barings delisted the company again in 2020 at a share price of 475. At the same time, CA Magnum Holdings bought the company for roughly 20,000 CR around same time, and they became a 95% promoter of it. And very recently, which is basically this week, CA Holdings has done an offer for share primarily and listed Hexaware back at a listing price of 7,000 or 700. It's an app boy.
One question that comes to my mind is that, I mean, they had an amazing journey, but now that they are listed, and rather I should say again listed, how diversified is their business now to have commanded such a premium? Are each of their services, operation segments, and geographies significant enough?
And I think that's a great question. And as we look into it, we should actually evaluate what they report and what our analysis actually shows. So if you think of it from a geographical revenue distribution perspective, US and Europe are the primary markets for Hexaware, with US commanding almost 3/4 of all of their revenue. This is common with most of the IT companies where US is the key market. But as you look at the operating segments, things become a lot more interesting. Hexaware lists six different operating segments, but they are the combination of them are not super intuitive. If you think of it, financial services and banking is actually the same operating segment. It is roughly 37% of all revenue comes from financial services and banking. Healthcare and insurance is the second big one, which is another 20%. But if you think of others, consumer and manufacturing should ideally be separate. They have very, very limited things which are overlapping. They're not the same industries. High tech and professional services, again, are not the same industries. And while consumer manufacturing is listed at 17% and high tech and professional services at another 16.9%, my assumption is these are actually smaller buckets, but they have been merged for the sake of presentation. So my take broadly is that primary operating segments for Hexaware are financial services and banking, one, and healthcare. Together, that is 58% of the revenue. Now, if you look at the services perspective, and this is actually again common for most of the companies which are in this segment, IT services is roughly 84% of the revenue, business process services is 12%, and others are 4%. Thinking about the consumers, Hexaware does claim that they have a very diversified consumer pool, with their top 5 customers contributing to 25%, top 10 customers contributing to 36%. But overall, I think that their concentration in the US market and in financial services and healthcare segments does show that they are not supremely diversified.
Hey, Prabodh, it's great to see. This is crystal clear. But don't both financial services and healthcare segments are in a phase of transformation, especially in US? Would that add tailwinds, or would it be a disruption to Hexaware's revenue stream in future?
Great question, Shom. And I think it's a mixed bag again for financial services and healthcare. Think of it, actually just do some sort of a industry analysis of these segments. So let's look at the financial services outlook, what it's expected in the US and also the healthcare challenges in US. Looking at specifically the financial services outlook, is globally financial services continues to face uncertainties given geopolitical tensions, given margin pressures, it being highly competitive, there being a lot of regulations. But specifically, if you look about the US, I think financial services are entering into an era of financial deregulation, so to say, especially with Trump coming in, where a lot of industry changes are expected to happen. Primarily, what is expected is in the next few years, there will be consolidation across the financial services industry, especially with the smaller players merging with the bigger ones, or smaller players merging together. I think that creates increased demand for IT services as companies have to go through transformation with each other. Companies have to sort of adopt new processes, adopt new systems. Further, initiatives like open banking initiative or the payment industry innovation that is happening further adds to more demand for IT services. What I feel broadly is that overall there will be an increased demand for financial services, especially from IT services perspective, and that would be good for Hexaware. But things are very different when you think about healthcare. Healthcare in US is primarily tackling the dual challenge of driving growth while also ensuring affordable healthcare. This is primarily the healthcare has been focused at strengthening their core legacy systems, and they're not really investing heavily in digital tools and transformative technologies. I, for a fact, know a lot of healthcare IT budgets have cut in various pharmacy-based companies or various hospital and patient maintenance record companies in the US. So I think that actually shows that there is a low upside available for Hexaware to expand in the healthcare industry. So overall, I think while financial services is optimistic, healthcare will continue to face challenges for Hexaware.
So there was a lot of buzz about Hexaware's AI platform, and even during the IPO and while the shares were getting listed, there was a lot of management commentary about their AI production platform. What's your take on that? Is it hyped or like does it have some substance?
That's a great question. So let's look at it again. Especially if you look about the AI products, the three broad products, there's Rapidx, there's Tensai, and Amaze. Let's look at each of these products quickly. Rapidx is a GenAI-based platform which is primarily for automating or improving the software engineering lifecycle. It allows you to code quickly, it allows you to build your systems quickly, and so on. From a financial services use case, again, we'll look at the use cases for the two industries that are most relevant for Hexaware. From a financial services perspective, it does have the potential to streamline development of digital banking platforms to enhance customer experience, accelerate deployment. From a healthcare perspective as well, it can facilitate rapid creation of telehealth applications, automate insurance claims, improve patient data management. So that's RapidX. Moving to Tensai, it is a automation platform which helps transform IT processes. I actually feel this is closer to the business processes services vertical of Hexaware or business process services offering of Hexaware. I I do believe that, or at least what Hexaware has claimed is that Tensai can help automate regulatory compliance for financial services, improve fraud detection, optimize the IT infrastructure, and from on a healthcare services, similarly, it will improve the settlement of claims, automate data processing, and so on. Amaze, on the other hand, is a cloud migration initiative, again, with a lot of companies, especially in the Fortune 500s, investing significantly in moving to cloud. Amaze is positioned to that bit of the service. Primarily, it can help for both healthcare and financial services, enable faster migration.
And who are the adopters or early client for these products?
Very interesting. So, again, my take is that while Hexaware has talked a lot about Amaze, Tensai, and RapidX, they have not really listed early adopters, revenue coming from it, and so on. So, I would actually think that they built the products, but they're not a lot of early adopters. I know for a fact that a lot of major players who have been in this GenAI journey, like Microsoft, Amazon's, and Google's, have services of helping big industries or big companies move to cloud, move to GenAI, move to better tools. So that's one set of the competition which Hexaware faces. The second set of competition is again IT services industry in India, which are also supremely well entrenched. And some of the bigger names also have their own have their own GenAI offerings. So my take broadly is that while these AIs products have shown the potential, since there are not a lot of customers on these products, we have yet to see whether they will actually give significant upside to Hexaware.
Prabhu, speaking about that, what other risks do you foresee?
Let's take a look at the risk again. This is an overview of across a lot of analyst reports and a lot of reading that I did. I think clearly there is revenue concentration risk in terms of the market or the operating segments. From a competition perspective, we talked about the same from a Gen AI basis, but it's a way that risk stays across the Hexaware offerings. And some of the competitors of Hexaware are actually bigger than, actually, many competitors of Hexaware are bigger than what Hexaware is, which adds to that competition. There's further technology and AI risk, which basically with AI, there is a risk of legal, ethical, data security challenges, and failure to implement that could lead to significant brand risk, significant reputation risk. And the last one is primarily to me the talent retention risk. So the Indian IT industry saw a peak of attrition around 23% in 2022. I feel Hexaware is in a high to moderate competitive space, and it would be good to see how it navigates the space. And maybe as we look at the business numbers, we can understand that.
Folks, now we will deep dive into the balance sheet of Hexaware Finance Technologies, and we will go through the data of last 10 years, right? One most important thing which I wanted to highlight was that the revenue has increased consistently. And so you can see here that the revenue has increased consistently, reflecting a strong business expansion in last 10 years. From roughly around 1948 crores in December 2012 to 10,380 crores in 2023. That's roughly about a 5x increase in 10 years as far as the revenue is concerned. So that's a big positive for a company. There's also a steady operating profit growth from 394 crores in 2012 to about 1,585 crores in 2023. It shows that it has maintained a stable operating profit margins of 15 to 21% throughout, right? EPS also has increased from 11.5 rupees to 33 rupees in 2023. So that has been a big reward for the investors as well. One thing I wanted to definitely highlight here is that the company is investing more in fixed assets. And that's why you see that such as office space, IT infrastructure, and data center. That's why you see that the depreciation expense has increased, and probably in last 2 years it has skyrocketed. One thing which does not make sense to me is that how come the investment on fixed assets is so high? Had it been in any other technological investment, it would have made sense. But for a company like Hexaware, investing unproportionally in office space and some of the other infrastructure doesn't really make sense. Maybe they are futuristic and they are looking into the future, and probably this may serve them in the future. But right now, this is something that probably needs more clarification from the management. Continuing with the financials, one thing you can see here is that reserves have increased significantly. About 1,145 crores to 4,500 crores. It indicates a very strong internal capital generation, which is great for the company. Borrowings were non-existent. Only from 2019 they started borrowing. That also at this point of time the numbers look quite low. Their fixed asset, again which we discussed about, rose from 444 crores to 2,454 crores. Again, we are assuming this may be driven by future business expansion, but this is something which probably the management needs to come up with a better clarification for. The investments basically fluctuated. If you can see, there was a significant drop in 2015. There was hardly any investment done from 2015 to 2018. As an investor, you do feel these as to why these investments were not done and what were they doing with the idle cash. But if you see now from 2019 onward, they have slowly started increasing their investment levels as well. Promoter holding hasn't changed very much. This gives you the ownership of overall promoter holding. At this point of time, we have about 10% of holdings from FIIs and about 8% from DIIs. Promoters have, obviously now that they have gone for an IPO, they have diluted their stake a bit, and public holding is around 6.3%. Coming to some of the major financial numbers, if you're talking about some of the important key ratios. See, one thing you can observe here is, as you move to the next one, let's look at the the graph. What has changed here as far as the key ratios are concerned is that the cash conversion cycle, it's basically how long it takes for a company to convert its investment in inventory and other resources into cash flow from sales, has decreased. It is from 70 days to 49 days, which actually indicates a very increased or rather improved cash flow management. So basically their cycle time to actually invest and get cash back from their investments as revenues is faster, basically, right? Debtor days has reduced from 68 to 49 days, which is again suggesting better credit allocation policies. So internally the company is managing their credit better. Working capital days has decreased significantly from 36 days to just 1 day. A working capital days is basically your working capital, how much time it takes for your working capital to start generating revenues, as in getting that cash back is basically your working capital days, and that has also decreased significantly. But basically means that the company is efficiently managing its short-term assets and liabilities. The ROCE has improved from 26% to 29%, again showing better profitability and capital utilization. A higher ROC means that the company is generating more returns from its investment, which is a great sign for the company. The one thing I wanted to highlight here was the PE ratio. Since the company in 2025, early 25, has come up with the IPO, and now that the shares have listed, their PE ratio is around 50, which is way too expensive. And in the graph also you can see that there is a huge hike. So at this point of time, it seems very expensive as far as the other companies are concerned. I will let Som talk about some of the peer comparisons.
Great insights, Vivek. Now let's see how Hexaware stacks up against some of the peers, right? So one of the key metrics to look at is the sales growth over time. Given that we still don't have 2025 numbers, what we've done is we are looking at from 2019 to 2023 sales number. And as you can see, Hexaware has shown consistent double-digit growth, increasing from 5,583 crore in 2019 to slightly over 10,000 crore in 2023. Now, if you compare it to some of the large cap companies, which is like TCS and Infosys, it is doing better. But again, you have to look at the base number also. So in case of TCS and Infosys, the absolute sales numbers are significantly higher. But Hexaware has shown consistent, strong fundamental and has maintained that steady growth except between 2020 and 2023. Let's look at how Hexaware is doing in terms of profitability and margins. So if you look at the left side graph is operating margin and the right side graph is net profit margin. This is slightly different story. So Hexaware's operating margin is fluctuated somewhere between 13 to 17% over the years, which is between 2019 to 2023. With a dip in 2022 before slightly improving to 15% in 2023. This overall suggests some operational challenges, but a moderate recovery eventually. Net profit margin, however, have remained under 10.5% since 2019, which is significantly lower than the peers, right? Which are significantly bigger companies, right? So if you look at TCS and Infosys, the profit margins are much higher, which is in double digits, close to 20%, while Hexaware, despite being a much smaller company, is not able to maintain good profit margin, which is a bit of a cause of concern in terms of efficient use of now let's look at the revenue segmentation. This is something which was already covered in previous slides by Prabodh. I'm trying to compare it with the peers. So if you look at Hexaware with and compare it with Infosys and TCS, there's significantly high focus on BFSI, which is banking and financial services. which are in similar type of businesses. I've also compared it with some of the other services company, which is Oracle Financial Services, maybe a fintech, but these are slightly different companies which have products which are more finance focused, and hence the percentage of the revenue coming in from financial services is much higher. But the numbers, as far as Hexaware is concerned, is in line with other services companies. So this has been already covered by Prabodh in previous slide in terms of how the businesses, the geographical distribution looks like in terms of the revenue, which is again, I've compared it with TCS and Infosys, which is the giants of software industries and benchmark for Indian market, and which the Hexaverse revenue is in line with these companies. A significant portion of the revenue comes from North America, then Europe, and then other regions over here. I've also tried to look at the retention number, how the company is doing. So as you can see, the IT industry is facing a major shift, not just in AI, but also in how the companies retain talent, because of a lot of challenges that the industry has faced since COVID. So what we're trying to do is we are trying to break down the latest attrition trends in top IT firms, including Hexaware, TCS, and Infosys. So Hexaware is trying really hard to retain the talent. Their attrition rate stands at 21.9%, showing a slight decline from their previous years. Plus, their employee retention rate has jumped from 68% in 2021 to 73% in 2022. A very strong improvement. Now, we look at the P ratio. This has already been covered by Vivek. As you can see, the P ratio of Hexaware is significantly higher compared to some of the more established companies like TCS and Infosys, but slightly lower compared to Persistent System. I think overall the stock is slightly expensive.
Actually, one of the reasons why, see, the biggest challenge which I see is that they have listed their listing price is quite high, right? And that is based on a lot of hopes and assumptions that their AI platforms and some of the other services will work wonders, right? There's a lot of bet on that, and that's why they have kind of taken care of that pricing and probably introduced it at a very high price. But as Prabodh mentioned, that it is yet to be seen how their platform is adopted and how much revenue does it bring in, and whether they're able to justify this high P ratio.
Great. Thanks, Vivek and Som, for a very, very detailed analysis of their financials and their competitors. Just to summarize, here is what I understood. There are some positives, like they have very low debt levels, they have high cash reserves, they have a good portfolio of AI products, high operational efficiency. Some clear negatives. For one, banking is their key vertical and it could be slow in adopting AI. They have low operating profit margin and net profit margin compared to competitors. Their stock is at a high P, which suggests that it is overvalued. Also, their employee cost is roughly 60%, which seems to be high, especially when they're investing a lot in products. And some open questions. They have a good sales growth, and Vivek, and you've covered that. But the behemoths in the industry have also grown at a similar rate, with almost X or 20x the size of the base. They have very high fixed assets in the last 4 years, which seems surprising for an IT services company. And the AI products are yet to deliver the promise they have. So my take and our take would broadly be that the stock currently seems to be overpriced. This was an offer for sale for CA Magnum, and it looks like a lot of profit that was available or upside that was available has already been priced in. And it is not something that we would invest in. Thanks.
Thanks.